Hello everyone, and welcome to this new video. Today, we're going to learn how to avoid common mistakes and how to choose the best ETF. Here's the table of contents with all the sections we're going to cover. After this video, you'll be able to look at the key information before investing in a fund, and then avoid common mistakes. The first thing you need to know is who's issuing the ETF. Who is the ETF issuer? You need to choose a strong and reliable provider. Ideally, it should be one of the top 10, so you avoid unnecessary risk. In fact, by doing this, you will avoid the risk of the issuer going bankrupt. It's rare, but an ETF provider could go bankrupt, and that would put your investment at risk. That's why it's important to pick an issuer with solid financial backing. You can easily find tools online to help you sort ETF providers, like the ETF database from VettaFi or the website justetf.com. Let's take a quick look. Alright, let's go to ETF database, a VettaFi website. Then, we click right here on ETF database. We scroll down to find the issuers section. It takes us to a page showing all the ETF issuers. Please note that this list concerns issuers based in the United States. There's a table where issuers are sorted by their revenue, and we can see that BlackRock is number 1, with an estimated revenue of over $5 billion, followed by Invesco with $1.5 billion, then State Street, Vanguard, First Trust, and so on. We can also filter issuers by fund flows. For example, over the past 3 months, Vanguard recorded more than $94 billion in inflows, which is huge. Then we've got BlackRock, Charles Schwab, and others. We can also sort issuers by return, AUM, expense, or dividend, but I really recommend choosing your ETF provider based on revenue. That way, we can be sure that the management company is financially solid. Ideally, you should pick from the top 10 issuers to select your ETF. We can also select providers on the Just ETF website to find issuers based anywhere in the world. So here, on the ETF screener, we click on ETF Provider, right here. We get a list of all the providers, including the ones available in Europe. If we scroll down, we can see all the world-renowned issuers. You'll notice iShares, which is the ETF branch of BlackRock. So, from this list, you just need to pick one of these providers to buy your ETF. You will have eliminated the risk of issuer bankruptcy. Now, let's talk about AUM, which stands for Assets Under Management. It's the total amount of money invested in an ETF by all its investors. You should always choose an ETF with an AUM higher than $300 million. That way, you avoid certain risks, like the risk of the fund being shut down due to low investor interest, or also a liquidity risk. This last happens when there aren't enough buyers and sellers, meaning the daily trading volume is low. In that case, you might have trouble buying or selling the ETF at the price you want, which could lead to price slippage. That's when you end up paying more or selling for less than expected, which leads to significant losses. Let's go through an example. We head back to ETF database and say we want to buy a real estate ETF. We click here and that takes us to a page showing a real estate ETF list. This list is sorted by total assets, which basically means assets under management. We can see that over $33 billion is invested in the Vanguard real estate ETF. In second place, there's the Schwab US REIT with almost $8 billion. As we scroll down, the AUM keeps decreasing. This ETF here is the last one you'd consider, since it still has $362 million under management, but the next one has less than $300 million. So you don't have to buy this ETF. Same thing for this one and this one. Now, if we scroll back up and decide to choose this one, for example, because it has a great year-to-date return, let's click on it and get all the details. The issuer is State Street under the SPDR brand. And if we scroll down, we can see the AUM is $7.4 billion. But we always need to double-check this information on the issuer's website. So here, on the State Street website, we look up the Real Estate Select Sector ETF, which is our ETF we just found. And as we can see, there's $7.4 billion in assets under management. This is the last updated data. So the information matches, and that means you can buy this ETF without worrying about a fund shutdown or any major liquidity risk. Alright, now it's time to talk about TER, which stands for Total Expense Ratio. It's the annual fee you pay to the ETF issuer, and it's taken directly from the fund. You should always choose an ETF with the lowest TER possible, and under 0.5% in all cases. This helps you avoid the risk of losing a big part of your returns to fees over time. Even a small difference in fees can have a big impact on your long-term growth, so always go for ETFs with a low TER. On the Just ETF website, you can check the TER. For example, here we have the S&P 500 ETF from iShares. It has a TER of 0.07%. If we look at another S&P 500 ETF, for example this one from Vanguard, it has the same annual fee. But this S&P 500 ETF here, from Invesco, has a TER of 0.05%, so it's slightly lower than the previous two. In that case, you might want to go with this one, because you'll save money on fees over time. Now let's talk about Dividend. You need to know that some ETFs either pay out dividends to you, those are called distributing ETFs, while others reinvest them automatically, and those are called accumulating ETFs. For long-term investing, you should always choose accumulating ETFs so you can take full advantage of compound interest. This way, you avoid the risk of missing out on long-term growth, because compound interest can be extremely powerful over time, as we saw on this previous video. Alright, on the Just ETF website we also get the distribution method information. For example, this ETF is accumulating, which means dividends are reinvested back into the fund. Same thing for this one. But look at this one, it's distributing, meaning the S&P 500 ETF from Vanguard pays out dividends directly to the holder. You'll see a lot of funds offering accumulating dividends, and here, there's another example of a distributing one. You really need to prioritize accumulating ETFs, because that way you benefit from compound interest, and on top of that, you won't pay taxes on the dividends. In fact, if you get a payout from a distributing ETF, you'll be taxed on that income. Now, if we go to the Verify website and use the ETF Screener tool, there's a dividend section here, where we get all the key info, like dividend date, frequency, annual yield, and so on. As we can see, most of the dividend frequencies are quarterly, which means these are distributing ETFs. That makes sense because most of these ETFs are from the United States, and US ETFs are generally distributing. If we take the SPY from State Street as an example, and click on the Dividend and Valuation section, we get all the dividend details. The income per share is $1.70. The last dividend was paid in March 2025. And since the distribution is quarterly, that adds up to an annual dividend of around $7 per share. It represents about 1.20% per year. Alright, now let's talk about Replication Method. ETFs can use either physical replication or synthetic replication. If you're not familiar with these terms, make sure to check out the previous video where I explained the difference in detail. For long-term investing, you should always choose Physical Replication ETF. That way, you actually own shares of the companies in the index. This helps you avoid counterparty risk linked to synthetic swaps. As we saw in the last video, synthetic ETFs use financial contracts called swaps to mimic the index's return without holding the actual shares. But if the counterparty can't pay or goes bankrupt, you're exposed to that risk, so it's safer to choose physical replication. Let's look at the replication method on the Just ETF website. Here, we have a column called Replication, and for example, this S&P 500 ETF uses full replication. That means all the securities in the index are actually bought under the investor's name. You own 500 stocks by buying this ETF. Then, for the MSCI World, we see something called optimized sampling. That's because this ETF includes a huge number of companies, so the issuer selects the major ones and buys only those on your behalf. That's still considered physical replication. But here we have a swap-based ETF, so let's check that out. As we can see, the replication for this one is synthetic. If we click on Basics, we see that it's based on an unfunded swap and involves a counterparty. This counterparty pays you the return of the index. That's why, by choosing a physically replicated ETF, you avoid this counterparty risk. Alright, now let's talk about currency. You may want to invest in other countries or in stocks that are traded in a currency different from your own. It's better to invest in a currency-hedged ETF to protect yourself from currency fluctuations. This helps you avoid currency risk, which means the risk that exchange rate movements reduce your returns. Let's walk through an example to make it clearer. Let's go back to just ETF website. If we scroll down, we find here a filter called Currency Hedge. Let's select Euro Hedged, for example. Now let's assume we want to buy this S&P 500 ETF from iShares. We click on it and see that the fund is in Euro, so based in Europe and designed for European investors. If we go to the Basics section, we can see the currency is listed as Euro, and it's Euro hedged. This means that if the dollar goes up and the euro goes down, you won't lose purchasing power because the fund is hedged. In fact, if we check the holdings, we see that the top 10 companies are all US companies like Apple, Microsoft, Nvidia, and so on, all of which are listed in dollars. So without a hedge, your euros would be converted into assets priced in dollars, which means you'd be exposed to euro-dollar fluctuations. But this ETF protects you by completely hedging that currency risk. The same logic applies to other countries. Take Japan, for example. If you want to invest in Japan, you can buy this ETF, where the fund currency is in euros and it's hedged. In the holdings, you'll find companies like Toyota, Sony, Mitsubishi, all listed in yen. So, to protect yourself from currency swings between the euro and the yen, you'd want to go with a hedged ETF like this one. In fact, one very important rule in long-term investing is that the majority of your portfolio must be exposed to your currency. So if you are American, in USD, if you are European, in euro, and so on. And finally, let's talk about tracking error. If an ETF doesn't perfectly follow its index, the difference between the ETF's performance and the index is called the tracking error, and every ETF has one. This gap can appear for several reasons. For example, when dividends are reinvested, the ETF may not place the money exactly the same way as the index. Or if a company in the index gets acquired, the ETF has to reallocate that money elsewhere. Fees also play a role in creating a gap. That's why you should always choose the ETF that has the lowest tracking error. That way you avoid the risk of underperforming the index you want to track. Let's understand that with an example. We start by looking at the VOO ETF, which is an S&P 500 ETF issued by Vanguard. If we click on Performance and Fees, we land on here, with a performance table. The first line shows the VOO ETF itself, and the second line shows the benchmark, which is the S&P 500 index. Over here, we can see the performance since the ETF's inception, 13.87% per year for the ETF, and 13.91% per year for the index. The small difference of 0.04% is called the tracking error. Now, if we look at the S&P 500 ETF from State Street, which is SPY, and go to the performance section, we see the performance table here, and the benchmark is also the S&P 500 index. Since inception, the ETF has delivered a return of 10.18% per year, while the benchmark shows 10.31% per year. That's a gap of 0.13%, which is noticeably higher than the previous S&P 500 ETF we looked at. Over the long term, this kind of tracking error can impact your overall returns. And finally, if we look at the IVV, which is the S&P 500 ETF from iShares, and check its performance, we see that the total return since inception is 7.52% per year, while the benchmark shows 7.58%. That's a gap of 0.06%, which is a perfectly acceptable tracking error. So remember, If you're hesitating between similar ETFs, just look at the tracking error and go with the one that tracks the index most closely. Let's wrap up this video with a quick review. First, we saw how to avoid issuer bankruptcy risk by choosing a strong ETF provider. Then, we talked about avoiding liquidity risk by selecting ETFs with high AUM. We also covered how to avoid high fees and how to avoid missing out on long-term growth by choosing accumulating ETFs that reinvest dividends. After that, we explained how to avoid counterparty risk by picking physical replication and how to protect yourself from currency risk with hedged ETFs. Finally, we looked at how to avoid index underperformance risk by minimizing the tracking error. Alright guys, that's the end of the video. I hope you learned something valuable and that you now feel more confident in picking the best ETF for your strategy.